So today we are going to underwrite a sample multifamily deal. And in the process, we're gonna go really deep into underwriting mechanics and see how our software can measure up to a sample spreadsheet. Um, so there's a lot of technical terms that will be used. And I think it will be a really good exercise for people who want to get into underwriting. And we're going to put this on YouTube and it's going to be pretty awesome. Now, this is a live deal, meaning that the deal is actually on the market and people are purchasing it. But by the time this video comes out, maybe people have already made offers. So there's no sensitive information being released. So let me go ahead and share my screen. All right, so this is a live deal. So this is not just a demonstration of our software, a underwriting software, but also gets really into the technicalities of underwriting, and it will be very, very interesting. So I have this deal in front of me. You can see that this is a offer that my business partner actually made an offer on, LY, letter of intent. And our job now is to convert this thing into our underwriting software. And we're just gonna go over it. There's also the SDA. SDA stands for a Simple Deal Analyzer. And this is a Michael Blanc spreadsheet. So we're gonna translate this into our version and see how it goes. So the first thing is I go to underwriting and then I'm gonna create a deal. So I'm gonna create this thing. And this is Milo. Okay. Here I can put in a purchase price, and I know the whisper price is about 32 million, so I'm gonna put in 29. Now, you can put in any number. Just put in like 5 million, 10 million. You can update this later, okay? And then let me upload a few images. And so let's see. Let me upload these images. Yeah. So I just took these images from the OM. Okay, so they look beautiful. Okay. So there's that. Cool. Submit that. Now, so that's Milo. So when I come in, there's nothing in here. There's $29 million purchase price, and then everything else is zero. Contrary to a typical spreadsheet where I basically have to go into the scenarios and do all of this unit types with the trailing T12 rent as well as the pro forma rent, I can get this done by just uploading a rent roll. So the first thing I'm going to do is upload a rent roll. And I'm going to use AI parsing for the rent roll. So click on next. And I'm going to download this rent roll. So there is the rent roll from September, from July. Let me go into contracts and not contracts. Oops. Let me go into here and then go into financials. It seems like there's a rent roll from October, right? So I'm going to take the latest one. Okay. I'm going to download this thing. Okay. I'm going to open it up as well so you folks can see. Okay. So a typical way is you take these folks, and we will like make sure that we anonymize these tenants when we upload them to YouTube. So I'm gonna upload this into our spreadsheet, and I'm gonna click on upload. And this might take a couple minutes. In this case, because it's a spreadsheet, we instantly parse the entire rent row. And basically what we did is we take a pivot table of the unit type, and we figure out the square footage, the minimum rent, maximum rent, average rent, and so on and so forth. If you click into any one of them, you can see that there's the bedroom, bathroom, square footage, whether it's upgraded or not. And you can add a memo if you want to. So you can actually do it on, basically we translate this entire rent roll into our version, okay? All right. Sometimes when you go to the units, you can see that in each unit, you can even figure out whether it's upgraded, vacancy, status, move-in date, move-out date, lease started, lease end, okay? Some cases, we couldn't parse the lease move-out. So like this one doesn't even have a lease move-out. That's why it's zero. Or because it's down units. That's why it's a vacant unit. But if I have a unit that's not vacant, you can see the move-out date. If we can see the move out date, you can go to Insight and then visualize, okay, these are all my rents. These are all my unit types. These are the rents for each one of the unit types and how many units are of each unit type. As you also can see at the bottom here, these are the months and how many units are ending their lease on that month. So there is an abnormally number of leases that are ending around like May, July, June, and August, or so on. And that is already suspicious because the seller is probably not doing as well, and they probably renting it to unqualified tenants during those months. So immediately, that is something to keep in mind. So I'm underwriting it this as with the fresh eyes. So I'm just making a mental note that I need to be careful. Like there's something might be wrong with these tenants, and I'm ready to potentially put in new tenants altogether. Okay, so that's already good insight. Cool. Now, if I go into the unit mix, the unit mix gets generated automatically, and so you have all these unit types, and you have all these rents, and you have the pro forma rent. Something to note here is that you can see that the rental increase is 52%. So the average rent is 870, but one of the rents is renting it for 52%. The way that this cash flow portal pro forma rent works is that, let me hover over this thing. It says, um, if rent roll AI parsing is used, this is taken from the maximum actual rent of each unit type. And so it can be changed. The generated number is simply an initial pass. So we, as the users, are encouraged to change these numbers to be something reasonable, as opposed to just taking the highest rent. That was just the first pass. And the fact that there's a lot of rents ending on a specific time, and also the fact that some of the pro forma rents are ridiculously higher than the average rent, gives me suspicion that something is fishy, and I need to update this. So this one gives me an overall increase of 36%, which is definitely not realistic. Okay. So what will be a realistic number? Well, let's just take a look at what my business partner has. And my business partner basically said, this is the target rent, this is the increase. Sometimes it will be higher and lower. So I'm just gonna take these numbers, okay? And I'm gonna come in here and then see if I can paste it. Now, the numbers may not line up. Okay, so it just literally comes all the way down. And so this is a 24% increase, 7% increase, 25%, da da da. This is a 30% increase. Okay, that sounds more reasonable. This is that, this is that, this is that. So you can see if you can copy a spreadsheet directly into our software, the units will line up. Okay. So basically you can copy between the two, copy and paste between the two. So I'm gonna do that. And then this one is a 22% increase. Is that reasonable? I don't know. I feel like this is also a little bit too much. Let's just take a look at this. So A1, 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 so that's correct. A2, A2, that's correct. And then A3, yeah, that's correct. And then B1, 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 three B1s, three B1s, that's correct. And then there are B2, B2, that's correct. And then B2 upgraded, that's correct. And then B3, aha, so they a bit two B3s, and then TH1. TH probably stands for townhouse. So all of this sounds about right. This is all correct to me. The one thing that I need to pay attention to is that how can we get 1400 on this one? So let's just take a look at this one, 1400. So yeah, so this one, it seems like there is only one unit that's doing that. So it's not the end of the world. It's just one unit renting for that much. So the average is about 22%. Sounds reasonable. And my total pro forma rent is 396. Let's take a look at what do they have. 396. So I match up with my business partner's spreadsheet. Okay, so far so good. Again, up to this point, I hope folks understand what's going on. We put in the pro forma rent, we match up to be something reasonable, but the AI already did the first pass. And so far, in our mental note, we know that this property is low occupancy. There's a lot of potential, huge value add. They're probably underwater. We don't know, but that's just the first pass. To go on more further here, you can turn on this advanced mode. And the advanced mode is very, very interesting. And this is an opportunity to get even more specific. And this is the really advanced part. So what do we have here? We have this thing called the development period. We have this thing called the lease-up period, and then we have this thing called the vacancy, and we also have the notes section. And then there's the frequency. Okay, so right now the frequency refers to how often is the rent, and so these are multifamily, so they are monthly rents. If this is a retail or industrial, it could be a yearly rent. So if I drop it down, if this were a Airbnb and they have daily rates, okay. Now, sometimes people use our spreadsheet, our software for hotel, and instead of a unit type, they just do January, February, and so on and so forth. And this is the monthly rate. Okay. And they will put a vacancy because the vacancies are different for January, February, March, and so on and so forth. Okay. So that's what the frequency and the vacancy are used. The next point is even more interesting. There are some folks doing development deals. And so what's happening is that the first 12 months they're renovating. So you can put down here like 12 months, I am just renovating. I'm not doing anything. And so for the first 12 months, my rent is just my old rent. And usually in the case of a development deal, you put at zero. So you start with a zero rent. You have 5 units that start with zero rent because that thing hasn't been built yet. Then there's the lease up period. The lease up period is saying that if this number is, say, 24, it means that it takes 24 months for the rent to go from the regular rent to the pro forma rent, assuming that you are increasing linearly month over month. It basically, the other way of thinking about lease up period is the absorption period. So it will take, in this case, if I put 12 here, and I put 24 here, what this saying is it takes about 12 months to develop this thing, and then maybe put 6 here. And it takes 6 months for all those units to be absorbed into the pro forma rent because it takes time to rent out each unit, right? In multifamily, there is no concept of development period usually, right? Maybe there's like a 2 months of development period. All those columns are in the form of number of months. But the lease up period could be, sometimes you say, well, I'm going to achieve a 22% rent increase. Right now, the default is 12 months. But I can say, well, I'm going to achieve it in the course of 2 years, which is 24 months. So I'm going to put 24 here. Okay. So then I want to put 24 across the board. So then how do we do that? We right click and then do fill down. So I'll fill 24 across the whole column. So all of my units, I'm making assumption that I will achieve the pro forma rent over the course of 24 months. So I'm going to save it. Okay, so that's, you can use the advanced version. Let me pause there for any questions. So far, does it make sense, or anything that I completely missed that I should explain before we move further?
So I had a question on the AI parsing. So did that Excel spreadsheet have to be in a particular row and column format in order for the AI to bring it in, or not?
Good question. The rent roll is usually of a certain format, and the rent roll comes from some of the major multifamily properties out there. And so you basically take what they have, and we usually can parse them. We are smart enough to know that this unit and this square footage at the bottom here, and then this market and market rents. We're smart enough to know that, hey, these are the same row and as opposed to different columns. This is really using AI. Like, we are smarter than a lot of humans can parse this. So the short answer is it works on 99% of the rent rows. We just launched the ability to parse PDFs as well. So you can upload a PDF and we'll be able to parse it, which is magic. So rent rolls are usually of a certain format, and we are able to parse 99% of the rent rolls out there, which is really cool. That being said, there are some hotel deals that don't have even a rent roll. There's no concept of a rent roll. Well, in that case, people say, well, if you don't have a rent roll, doesn't mean that your software does not work for us. That's not true. In fact, rent roll is just a shortcut. Rent roll, you don't need a rent roll in order to use the software. Similarly, you don't need a rent roll to use the spreadsheet either. But the downside, if you don't have the rent roll, is that you're plugging in the numbers by yourself. So rent roll is just a shortcut. By the time you upload a rent roll, you basically don't have to use the rent roll anymore. Everything else is based on the unit mix, which is the thing that you want to fill in to get your gross potential rent, right? The rent roll is just a means to an end. It's not. We actually, by the time it gets to this unit mix, we actually have nothing to do with the rent roll. The rent roll is just to give us some insights, some visualization, and then going forward, for the rest of this underwriting, it only depends on unit mix. It actually has nothing to do with rent roll anymore. Okay, good question there. All right. So that's very cool. The development period and the lease up period. A lot of our customers do build to rent. So they will say build for 12 months with zero rent. And then there's a lease out of 24 to 36 months. And that's what this is used for. You can see that there's one more column called vacancies. And the vacancies are as follows. The vacancies are saying if you have an Airbnb or a short-term rental, and each one of those Airbnbs have certain different vacancies. And so that's where you want to plug it in. So that's nice. Okay, we also have that. All right. So at this point, things look fine, but the IRR and the total return are not realistic yet because we have not put in our expenses. Okay. All right, so let's go to T12. So there's the red dot that indicates that, hey, this is the next action. For the T12, we can also parse PDFs. But for now, I'm going to take this August, which is my latest PDF. Okay, going to download this thing. Okay, I'm going to open this up to show you what it looks like. This is the T12. T12 stands for trailing 12 income statements or profit and loss statement. Okay, so this is what that looks like. So I'm going to come in here. I'm going to upload this T12 now. And then I'm going to drag and drop this T12 over. I'm going to click on next. This could take up to a minute. But if we already know the categories, then it's instantaneous. If we don't know, then AI will basically go through every line item to match out. Once you parse it, our AI is smart enough to give you the preliminary categorizations of the income statement. So what does this mean? This description, total month 1, month 2, month to 12, is what's coming from the spreadsheet. So this is month 1. So if I want to do market rent, it's 354,000. Market rent, 354,000. 354,000. So all of this is correct. And if you want to check, say, total deductions is 87, negative 87. And then total deductions, where's my total deductions? Total deductions, negative 87, month 1. That's correct. So we already built a map between our T12 representation and the T12 that you have in question, which is really nice. Okay. So then this is the data source. Okay, treat this as the data source. And our job now is to classify them. AI does the first pass, but ultimately the human is the one in control of what to classify. So the AI is saying, well, this row number 7 from your basic spreadsheet, the T12, is going to be classified as rental income. And that's correctly rental income. The next one is loss to lease, which is also part of the rental income. The next one is called total gross potential rent. And it is correctly saying that I'm not going to classify this row. That's because if I were to classify this row, then I will be double counting. I'll be counting the market rent and the subtotal. And I don't want to do that. So you'll leave this blank. And the AI already automatically leaves it blank. But if you want to change it, you can change it. Similarly, all the deductions are part of the rental income. So I'm going to count those as my rental income. Also, similarly, that total deductions is already double counted. So I'm not going to classify it. And so as you can see, the way you're going to classify this spreadsheet is that all the subtotals, you don't want to classify it. All the empty rows, you don't want to classify it. All the headers, you don't want to classify it. This net rental income, which is the total of all the subtotals, you also don't want to classify it. Okay. So the classification column is the one that you want to change. Let's move on. Here you have the other income, and we classify all these line items as other income. Then I classify all these maintenance requests as maintenance requests. Okay, so we go into the expenses now. You can see that here is a turnover cost. Okay, this is a turnover. I'm classifying the turnover cost as maintenance requests, but I can come in here and I can reclassify it. Maybe I will create a new expense type called turnover costs, like that. Okay. And I'm gonna create, because this probably seems to have a lot of turnover costs, so I can create a new expense type. And what I can do is I can, just like spreadsheet, I can drag and drop down, and so I can classify everything within this section as turnover costs. I'm gonna save it. So I am changing my data source because I have updated information about how I want to underwrite this. Okay. The labor costs, I'm classifying as payroll. That kind of makes sense. The advertising, I'm classifying as marketing. That kind of makes sense. The general admin, I am classifying as general admin. That makes complete sense. Let's look at the utility. So the utility has electricity, it has water and sewer, it has more utilities, it has meter, and it has other utilities. So I'm going to classify this water and sewer, which is 129,000 total. I'm going to classify as water and sewer. Okay. So I'm going to search for water and sewer and classify as water and sewer. This utilities recovery, I guess this is also electricity. This is meter and submeter. I think this is also water and sewer. Okay, like that, water and sewer. And the other utilities, I'm gonna put it as electricity. That's fine. Okay, for now. Okay, I'm gonna save it. This is the property management fees. That's fine. Insurance, that makes sense. Property tax makes sense. And then underneath it here, you can see that there's security patrol, bulk internet, valet service, locator fee, passive rent, da da da. And then that's all classified. But maybe why am I not classifying the last few rows? That's because if I were to classify them, then I will be double counting because they're just the aggregate of the line items above. So you're not classifying any of the subtotals. Okay. You can change it this however you like, but this is a very, very good pass. Once I go through all of these line items, which gives you the certainty that this spreadsheet is correct, I'm going to click on generate. I'm going to generate the income and expenses out of my data source. So go ahead and click on OK. And then the models get generated at this point. And so now I have a pretty good sense of my IRR and my total income. But let's check it out. So let's go into expenses. The expenses here are saying that, well, I have this repairs and maintenance, and the T12 is giving me about $272,000. Okay, that's cool. And it's about $839 per unit. Based on my previous underwriting, I budget usually about $400 for per unit for repairs and maintenance. So I'm doing better. Whether it's gonna be 400, 600, 800, that's the art is in the eyes of the beholder. You can change this to whatever you want. The turnover cost is about $536 per unit. So I'm gonna do $500. And in the drop down, I can say per unit. So this is my pro forma. This is my T12. This is my pro forma. Okay. Payroll is about $1,700 per unit. I am budgeting $2,000. Marketing is about $300. I'm budgeting about $200 per unit. General admin, they had $300. I'm budgeting about, say, $250 per unit. Let's do 250. Electricity is about 365, and we're gonna budget about $300 per unit. Water and sewer is 425, and we're gonna do $450 per unit. Okay. Property management, they have about 398. I'm gonna do 3% of my income, so I can do that, and that's about $424 per unit. Insurance, they have really expensive, 1,200, and insurance in that area is probably about $900 per unit. So, because in my real estate business partner's quote, he was able to get some quotes on the insurance so that he can do it cheaper. Okay, so if you're going to say OM, actually not OM, if I come in here, subcontracts, you can see some of this stuff. Okay, so he budgeting in 900, but again, this is whatever your number you want to change. The next step is the property tax. The property tax, there's a mileage rate of 2.44%. So 2.44% of the price. So I can do a percentage of the purchase price. And that came out to be about $700, $700,000 per unit. $700,000 total, about $2,100 per unit. Okay. And then contract services is about $950 per unit. So as you can see, their expenses is 2.8, our expenses 2.7 or 2.78, very, very close to their pro forma, to their T12 expenses. The way that my real estate business partner does it is that if I go in here and I go into the scenarios and I come down, my real estate business partner came out with a 2.7 million in terms of expenses, and I came out with about 2.78. So we are budgeting the expenses higher than my real estate business partners, which is fine. Let's go with that. Okay. So at this point, you can see that we have a 16% IRR, 100% return. Makes sense. Okay. All right. Any questions up to this point while we're going through this deal and classifying the expenses? You can do pro formas based on the per unit, per income, per price, based on the percentage of price, and so on and so forth.
Yes, so I saw that it looks like it brought in the chart of accounts, but it wasn't in a separate column.
Say it again.
I see that it brought in the chart of accounts. If you go back to,
Mhm.
yeah, right there, the T12, I think.
Yeah, T12. Yep, here.
Yeah. So, you got your chart of accounts there in the description, but it
Yeah,
didn't
that's
create
right.
a separate column for that. The I,
Yes,
the AI didn't.
yes, the AI did. The AI already created this turnover cost as a new line item on the expenses.
Yeah, but on the AI, the chart, it looks like you have a chart of accounts on the
Um,
T12. Like,
T12, this is not exactly a chart of accounts. It's just saying that what classification you want to classify. You can think of as chart of accounts, but this is the rental income, this is other income. All the income stuff go into the income. So like if I look at projections, this is everything that was income, we classify as income. And that's on the income side. Everything that's expenses, we move it to the expenses side.
Mhm.
Now, if you go into the T12 and then you reclassify them, and you and you it does not change the expenses yet. You have to regenerate it. Once you regenerate it, it will just create a new scenario, expense scenario, without losing the old scenario. Hmm. What's the part that you feel like got lost?
Well, I see there under the description, like you have 4400-00. It's on row 7 there, row 7.
Ah, yes, 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 yeah,
There's
yes. Okay.
there's your there's your chart of account number, and it's simply not in a different column. Why does the AI bring that in under the description market rent? Why is there not a separate column?
Oh, I see. So the AI, if you look at here,
See, it's a
there
different
is
column in
that's
A.
the
Yeah,
chart of accounts, right? And then
yeah.
here is the income market rent. Um, we combine them together because we're smart enough to like the 4,400. This is coming from the T12 that you are trying to underwrite. Every T12 looks different. Sometimes they're combined, sometimes they're not combined. And what we do is we are only using the descriptions to help you classify. All these numbers actually don't do much. They just there to help you maybe visualize the row number 12 here. Let me go in here. Row number 12 stands for vacancy loss. And sure enough, on the spreadsheet, row number 12 stands for vacancy loss. So this first column is really just to help you visualize the T12. They're like, hey, we did read in the T12, and this is what that looks like. Um, the
Okay, and
4604 is actually not used for the purpose of underwriting.
then my second question is the AI smart enough to know whether or not your
Mhm.
spreadsheet is reading from left to right or right to left? I think the way you have it set up is that you have the
Mm,
most recent month towards the right, and the oldest to the left?
Good question. So the way the AI actually works is that it puts the total as the first column, and then it will put September and October. So it's a little bit different. It's basically putting the total as the first column, and then everything else remain in the same order. The AI is smart enough to know what each column and what row stands for, and it's just a matrix, and we're manipulating that matrix. The reason, by the way, we put the total as this one as opposed to all the way at the end, that's more of a aesthetics and semantics. Because sometimes most people like to read, oh, this is the total. That's cool. We could also have put the total at the end. So in that case, you're just looking at this and then you're looking at the end. That might actually be better. That's more of a aesthetics thing. That's a fair point.
Okay, so
Mhm.
my last question, because it's hard for me to see when you switch back and forth. So the month one here, you got total, and then month one, is that the most recent month or is that
The
12
oldest
months
month.
ago?
The
That's
oldest
the
month. So
oldest.
if you look at the net rental income is 258, 215, 258, 215 for September,
Okay,
which is the oldest month. And it will be month one, 258, 215. So
gotcha.
what makes it confusing is the total is first column, but that's simply because we're not reversing it. We are just putting the total in front, and then all the months were still in linear order. Yeah, that's right. Cool. Excellent. All right. So that's that. All right. So then let's get more into it. All right. So this is getting really interesting. So basically at this point, I have the entire spreadsheet done. Obviously, the art is in the expenses. The art is in the unit mix. Okay. But we are providing the tool for you to do easy analysis. Let's check out a few things that is very exciting. So one thing that's exciting is the following. If I click on projection, okay, so actually, let me come in here. One thing that's exciting is if I click on that blue link, okay, I can make a copy of a scenario, okay, and I'm gonna come in here and I'm going to call this one of higher property tax increase. Okay. So it's exactly the same expense right now as the previous version, right? So this is the regular expense. This is the higher property increase version. And right now the IRR is 16% and 105%. So I'm gonna make the newer one, the higher property tax increase, the active version. Okay. If I click into it, so what am I trying to do here? I'm trying to see what kind of impact the higher property tax has on my investors' returns without overriding a previous scenario. So if I click on projection, you can see that right now I'm projecting about 3% expense increase throughout the rest of the year. But not all expenses are created equal, right? So I'm going to actually make the property tax increase at a higher rate than my normal expenses. So I can do the following. I can do, say, 15% is my property tax increase, and my insurance is going to increase by 12%. And the second year is going to increase by 10%, and my insurance at the second year is going to increase by 10%. Okay, 10%. And then going forward, I'm gonna hard code it to 3% just annual increase. So then what our software will do is that it will take the weighted average of these two line items of which is the special cases, and it will put a weighted average, and then the normal increase is actually say 3%. Okay. So that actually end up being about 7% total expense increase. Okay, on the first year. And then here is the 3% here and 5%. So I'm gonna save it. Okay. What would that do? So that will actually do that. Okay. So that will change it. Cool. So that will increase the expenses throughout. Okay. Now, if I go into here, okay. All right, so you can see that this is the T12 expense and this is the pro forma expense, okay? I need to double check on what's going on here because what it's supposed to do is that that should have an impact on the returns. But let me double check with the team on this one, okay? Cool. So that's one thing you can do, which is based on the projections, you can have different increases for different expenses. So that's nice. Let me move on to a separate part, which is on the finance section. Okay. The finance section has a few things going on. It has your capital expenditure, which is your renovation budget. Okay. So, and you can put your renovation budget in here, which is your capex. Okay. So, for example, I can do, say, out of the 100 units, I'm gonna spend about $8,000 on it. I'm gonna put some roof repairs, and the roof repairs is, say, 200,000 right here. And I also want to budget the fact that I have a contingency, meaning that maybe my capex will be higher than it is. So the contingency is whatever I have, just add 10% buffer to it. So if it's a million, it will be 1.1 million. Okay, go ahead and save it at this point. Okay, so that's my capex. Now, if I go to finance, right now, 1.1 million is the entire unfinanced rehab. But if I put, say, $500,000 of that is gonna be the finance rehab, and $600,000 of is the unfinanced rehab. I can do that. Okay. Now let me zoom in here a little bit. What else can we do with the loan? With the loan, right now, I have a 65% loan to cost, 36 months of interest only, and then 30 years of amortization. What I can do is I can say, if I have a supplemental loan, I can add a new loan to it. Okay, I can add a new loan. If I scroll down, I can also refinance this. Okay, I can refinance this. This is very nice. Where I say, well, in 3 years, I can go ahead and refinance this. So that's very, very nice. Okay, so let's come in here. Let me go into finances. Okay, and here's the example. Let me go ahead and create a copy. Okay, and then come in here. And then on the finances, I can say refinance scenario. So again, I'm checking what happens when I refinance. So I'm gonna make refinance the active version. Okay. Coming here, and let's see, within, say, 3 years, I'm gonna refinance. And when I refinance it, the cap rate is about 6%. That's fine. And then the target is 70%. The interest rate, let's say 5.5. In 3 years, the interest rate has dropped. And then I got 3 years or 36 months of interest only. That's all fine. And then I'm going to save it. Okay. So let's come in here. So if I go to finances, if I refinance, my IRR is 18% and my total return is 92%. When I refinance, because I give some cash back, that will increase the IRR. So, but if I don't refinance, which is the normal scenario, then my IRR should drop. So if I make this the active, watch this, my IRR is 15%, keeping the total return the same. But if I do refinance, I will achieve an IRR of 18%. The total return is very similar. So this will show us that by refinancing it, I have increased my IRR. It keeping everyone's return the same, but it increases IRR because it gives the money earlier to the investors, right? What we have shown through the software is that you can make a scenario for refinancing your property without sacrificing the fact that you have another scenario that you have already developed. If you're using a spreadsheet, you can imagine that in order to do any kind of new scenario, what you have to do is you can make a copy of that spreadsheet, change it, and then make a copy of another spreadsheet, change another part of it, and then you get this very complementary expansion of all the scenarios you have. But whereas in here, the unit mix, you can have as many scenarios as you want. The rent roll, you can have many scenarios. The closing costs, you have as many scenarios. Capex, you have many scenarios, and so forth. Income and expenses. So for every one of them, you can actually toggle between the two. Okay, so that's very, very nice. Okay. All right. So at this point, the IRR is about 18%. Total investor return is 92%. This is the whisper price. Okay. Let's say, for the sake of argument, let's go into our summary. Okay. And let's look at what a typical LP will get. So the LP, you can plug in this $100,000 investment or the $50,000 investment. So I'm gonna do a $50,000 investment, and so the software will update it directly to the $50,000 investment. Okay, so year one, it's got zero. Year two, it's got zero. Year three, it's got some money back as part of the refinance. Year four will be zero. Year five will be getting more money back when you're trying to sell. And so that's what will be what's happening. Okay, sources and uses, any of the unit mix. When someone export this as a summary, it will have your logo on it, and it will have all the sources and uses. And then at the bottom, you will have the images that we uploaded. Okay. So obviously you can download this thing and give it to your LPs, and then your LPs will understand this. Or you can technically share this underwriting directly with the LP, and the LP can play with the numbers to see how they can adjust the numbers. That's a option that you as a GP have. Okay. Now let's go into here. So over here you can see that because we're using the finance scenario, there's a refi on the third year. If you don't do the refinance scenario, so let me go into finances, click on this link, and then I'm gonna make the unfinanced, the one without the refinance being the active scenario. So click on this. Then if I go into summary, you can see that there is no more refinance on the third year. And instead, you just get the total from the sale. So as you can see, you can swap different scenarios very, very quickly. And that's the biggest advantage. Okay. Let me pause there. Any questions up to this point? Mhm. Does that make sense that you can switch the scenarios and then you can swap them very easily?
Yes, so does the software right now create a page, a one pager with all the different scenario summaries so that you can see all your, different scenarios on one page, or do you have to go back and simply, pick one?
Good question. So your question is, can they, can I see a comparison among the scenarios? Like I have two cars, I want to compare the specs of two cars. Currently, it does not. You do have to keep um, doing it, and then when you export the summary, you can you see this just the active scenario in that case.
Correct.
The
Okay.
next it is within the roadmap to say, hey, AI, help me pick the best scenario. That's a little bit complicated because the output is in the eyes of the beholder. Um, do you optimize for risk or do you optimize for total return? So there's that. Mhm. Yeah, good point. Okay. So that's that. If you go into the modeling, by the way, so this is the modeling. You can see all the numbers are clickable. So like, for example, if I click on this, this will go back to here, which means that, hey, in order to change these numbers, you need to go back to the unit mix. If I go into modeling, modeling is actually the page that you look at the most. Basically what it's saying is like, hey, if you have any question about this organic rent growth, which is 3%, year over year. If you don't believe that, click on it. And then here is where you enter the 3% input. Okay, for example, if I change this to 3.5%, and I'm assuming that every year it's going to increase by 3.5% because of inflation. If I save this, the IRR should increase automatically, right? If I save this, watch this. So I'm going to save it, and then IRR changes to 17% immediately, which makes sense because you're increasing the rent. Okay, so that's kind of nice. Maybe Paul, to answer your previous question just a little bit. So we don't have the ability to compare the scenarios side by side, but we do have the ability to simulate what happens to the exit cap rate across the board. So as the exit cap rate increases, obviously your returns drop because you're selling it at a cheaper price into the future. And so this is what happens to the equity multiple as the exit cap rate increases or drops. Here, you can see that if it's 6% cap rate, is 2.1x multiple, which is 110% return, makes complete sense. And then when it drops, your returns will go up. And this is the proportion in which it goes up. Similarly, you can look at a comparison between the rent growth and the cash and cash. If higher the rent growth, right now we're measuring 3.5%, but if it drops or increases by 50 basis points on either side, this is what happened to your cash and cash. So the worst case, you can expect about 5.2% on cash and cash. The best case is 5.8. 5.8 cash and cash is really good in today's market. Okay. Then here is a more complex chart. This is actually something that Lone Star Capital spreadsheet has included, and we included here as well, which is what happens to be the combination of rent growth and cap rate. And so this is like a almost like a three-dimension matrix. You have the x-axis, y-axis, and the z-axis is what happened to the equity multiple and the cash and cash. So that's what that looks like. And then this is an even more complex chart. And then this is what happened to the exit cap rate and the IRR. Okay. So obviously, higher the exit cap rate, the lower the IRR. So in this case, it seems like the worst IRR is 14%. The best IRR could be 20%, which is really, really good, I guess. And then finally, the total return here. Okay. So that's what that is. Okay. The last thing, 1 second, let me double check. Cool. All right, cool. I think Paul, you do have to go. Thank you so much. Cool. All right. Okay. So the last thing I'll go over is the fact that you can add these documents here. So for example, Ed added a bunch of these contracts and these kind of the flyers and OMs. You can upload those documents here as well. Okay, cool. I think yeah, I wish there were um I think this is a really cool software, and this is you got the rent statistics and the pro forma, and we are going to upload this onto YouTube. Um, I think to summarize, there are a few things that we believe a software does better than a spreadsheet. The number one reason is that it is intelligent enough to parse your rent roll and your T12, your data sources, and we automatically start making sense of them. That allows you to save about 95% of the time in terms of underwriting the first pass. In a lot of our demos, our customers were most amazed by our underwriting software. In fact, they probably like our underwriting software better than all the other softwares because to them that's magical. For anyone that has underwritten before, it was very time consuming, and this cuts out 95% of the time. So that's the biggest benefit. The second benefit, in my opinion, is that when it comes time to share your underwriting software with other people, it turned out that a software is more accurate than your spreadsheet, which is ironic. I did not realize that was one of my lessons because I have seen a lot of spreadsheets at this point, and honestly, a lot of the spreadsheets are wrong. To give an example, we have spent a lot of time on the finance and the fact that there's the interest payment, there's the annual debt service. I have looked at some of my prior mentors' spreadsheets. They are actually wrong. Their debt service does not take into account of amortization. And so it's actually incorrect. It's actually inflating the returns. And you can imagine if everyone is putting their own formulas on their spreadsheet, there's actually no basis of truth. And LP is like, oh, this is great, 120% total return. Good job. But the formulas might actually be incorrect. And so we strive to be a very accurate underwriting software, meaning that the numbers are correct. There are a lot of lack of standardization across the spreadsheets. To give an example, this is a 5-year model, but some spreadsheets were actually taking the NOI of the 6th year to calculate the exit cap rate and the exit sell. That's not correct. That's just not correct. And so that's actually inflating the numbers. So what we believe is that if the industry has a single software or a few softwares that agree on the way of doing things, it gives the LPs a peace of mind that, hey, your numbers are correct. I can change the input variables, but at least I can trust the calculation. And so that's the second huge advantage for the software, which is it standardized the calculation. There is no kind of like magical formulas within. Okay. The third thing that I believe the underwriting software is going to provide is it provides a way to help you avoid making bad mistakes. So, for example, on the rent roll, if you look at this deal, I need to be careful the fact that there are a few months that have extraordinary amount of leases end, and as a result, I need to be careful about the quality of my units, quality of the tenants, the quality of the seller, and so on. And these kind of insights will have been amiss if you were just purely using a spreadsheet. Okay. And then finally, I will say that a the more that you use a software for underwriting, the more it learns about your preferences and what you optimize for. And you can, send a T12 and a rent roll to an email address and it will automatically parse it for you. And so you are more likely to underwrite a deal because it's easy to underwrite that deal. When it becomes cumbersome to underwrite a deal, then it you are less likely to do so, and you actually might miss a deal that's a really good deal on the market. Okay, cool. So for the people that are watching on YouTube, the way to get started is you go to underwriting and you can just create a company portal and you can get started. You actually have a free deal to try out. So you can do all the things without getting any of the features. And then if you want to go in and do the unlimited underwriting, it's $79 per month per seat with unlimited underwriting for that one person. And you also have a 14-day free trial by creating it. For the sample deal, it's forever free. We can keep playing with that sample deal, and so on and so forth. Okay. All right. So that's on underwriting. We truly believe that in the last few months or years that we have come a long way on our underwriting software, and we believe that that will be the future when it comes to multifamily underwriting or even industrial or hotel underwriting, because they are all kind of just a manipulation on the profit and loss statement. So I'm very excited about this, and in fact, I have a demo literally in 5 minutes, and they're gonna talk about underwriting as well. So thanks for listening. I know this is a long video, but thanks for listening, and have a good one, everyone.